Hello and welcome to Trade Maestro. Thank you for joining us. We know your time is valuable and we take that very seriously. Our presentation will begin shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next top thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was, and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
It just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable. It's comprehensive. And it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning, good afternoon, wherever you are. Welcome to another episode of Building Blockchains. I'm your host, Jeremy Whaley. It's so great to be with you today on this Monday as we're starting a brand new week, and we got a lot to talk about. We got some exciting stuff ahead, and I'm thrilled to be with you today. As we jump into this new week, what are we going to talk about? Well, we're going to do a little bit of market updates, and I'm going to warn you, it's kind of looking a little bit red again. Then we're going to jump in and talk about some news headlines and the extreme sentiment in the news headlines, followed by discussing a follow-up to what we talked about on Friday with the Crypto Fear and Greed Index. And then I've got a discussion today for our Crypto Basics on coins versus tokens. And there's a lot of confusion. What's the difference here? We're going to talk about that today, and I think you're going to have a lot of clarity by the end of this session. And then finally, we're going to wrap up today in our Crypto Alpha with learning about candlestick charts and how we read them. So some really great stuff coming. I think you're going to get a lot out of it. And with no further ado, let's jump right into our market updates. And here we are, another ocean of red today. You can see Bitcoin's down another almost 2%, $1,700 down to 92,490. Ethereum's down, Solana's down, Cardano, XLM, and XRP, they're all down. It's just like the Red Sea. We need Moses to come and help us pass through the Red Sea. We need this whole thing to open up so we can get to the other side, right? Well, that's what it feels like sometimes, and if you pay attention to the news headlines, it's kind of what they're telling you, but let's take a look at where things are on the chart. You're looking right now at the Bitcoin chart, starting to look like a lot of lines on here because we put a bunch on. We did this all last week when we were talking about trend lines and different things, and I really hate to get rid of them, even though it does clutter the chart a bit, but take a look at what we've got drawn on the screen, and you're going to notice that we've drawn this trend line with multiple touches on the line. We've got at least 3 touches right along that line, and so far we're still right in line with about where we should see the buying behavior coming in. And I'm still contending that that's actually what we're going to see. When I look across all assets right now, when I look across the stock market, I look across crypto, look across everything, what I'm seeing is that this is a healthy sell-off. This is not necessarily a panic, despite what some people are saying. And this is actually a natural up and down cycle of what we should see in the market. I also think that we're getting really close to the bottom. I've been saying this for a couple of weeks. If you look at this chart right here, you can see, again, we're at that support level. Now, we could stay there for a long time. We could also drop below it, but we could stay there for a long time. The key idea here is that we're at that price point. And if you look down here at our stochastics at the bottom, you're going to see that we're starting to get a little bit oversold. And this is a good idea as well, or a good sign, I should say, as well. It doesn't mean that the trade has to go up, but what it means is that the momentum is becoming too extreme in one direction. In this case, the direction is a bearish direction. If you look back on this chart, you can see the last couple of times that we've been down here at the bottom of this channel, at the bottom of this trend line, what's happened? We've also had similar oversold readings with our stochastic because that's the bottom of the momentum. That's where it should be. So if that forecast holds true, then what I'm looking at moving forward, I think somewhere very soon here, we'll start to build that base in here and we'll start to rally out. And I actually am forecasting that we'll see Bitcoin rally up to and beyond previous highs. I'm going to say at least 120,000, maybe 125, 130,000 before we hit the top of that channel. And if that channel holds true, which would be a very healthy sign actually, then we'll be looking at another sell-off sometime in the first part of the year, where we'll start to have another one of those cycles. And guess what the news media is going to do? They're going to freak out. They're going to tell everybody, run for the hills. It's dangerous. It's horrible out there. They're going to tell you all this stuff, and some of y'all are going to believe it. I don't know why, but some of you are going to believe it. Let's take a look over here at Ethereum. Ethereum is down only $76, which really is not a big deal. If you look at the price action itself, you notice we're right in one of those major support zones. And that corresponds to not just what I'm saying, but with what several other people are saying as well. I'll talk about that momentarily. XRP's dropped down to $2.14. I've been calling for this for a while. Actually, back when we were at these extreme highs, I was saying exactly right there in August. I told my Sunday night profit picks class where I do live analysis and I set us up for the week. I told them then, I said, you know what, XRP is going to start selling. And I said, get your eyes down here. And I told them then I thought we'd see an opportunity to start buying around $2 or just above $2. And there we are. We're kind of hanging out there. We're going to base here for a little bit. For those of you who are absolute lovers of XRP, fantastic. I love you too. But just be prepared. You're going to be stuck here for a little bit until it builds that momentum, until we build the support, until we can go to the next level. All right, so let's take a look over here now at XLM. This is another one. I'm a big fan of Stellar Project. I'm a fan of all these, actually. But XLM down to 24 cents today. Big shout out to Deepan Gangley's a longtime coaching student of mine, and he helped me get these numbers bigger. So thanks, Deepan. I appreciate you, brother. Appreciate it. I can finally see. I've been squinting and dying here trying to look at this. Take a look over here, though, as I was saying, at XLM. We're back at 24 cents. We're so close to these support levels. And I'm really excited because I've been wanting a good chance to buy some more XLM at a cheap price. I sold most of all of it back around 45 and 50 cents. And now we got a new opportunity, and this is fantastic. And that's the beautiful thing about a pullback like this. When you have a down cycle, you get an opportunity to buy in at a cheaper price. Many of you are in Solana projects. You're looking at meme coins. You're looking at different aspects of Solana, and you've been needing to get some Solana. Guess what? We're back. We're back, baby. We're down to $130. What a great price to be picking up some Solana. And if this doesn't hold as support, we're looking at moving all the way down here just over $100, which, you know, compared to where we were, I mean, if you bought up here at 250, 260, you're going to be like, oh, this is terrible. It's terrible. And it feels terrible. I'm not saying it doesn't feel terrible. It feels terrible, but it's not terrible. It's actually healthy. And what you're going to start to see is you're going to start to see that support coming back in, and the projects will start to build their sustenance behind it, and then we'll start to see another cycle. And thus the trends and the cycles of crypto will continue because that's what they do. And it drives people crazy because they're not used to it. They don't know how to think about it. But ladies and gentlemen, fear not. This is exactly what we would expect with this type of a market. So just hang on. As they say, hodl. I hate to use that word because I don't really believe in the concept of hodl, but you know, hang on. I mean, if you've been holding on this far, you may as well hang on through all of it. Go ahead, diamond hands, hodl through it because there will be another bull and we will come back up again. It's just a matter of time before we get there. All right, let's take a look at the news and see what's going on. All right, take a look at... My tabs have gotten messed up. Forgive me for that. My news story that I wanted to start with has disappeared. Where did it go? Here it is, right here. This is what I want to show you right here. Take a look at Yahoo Finance and notice the headlines. I didn't even want to pull all these out. I just wanted to highlight them for you and show you how bearish things have gotten. Like, it's miserable. I hate looking at these news headlines. I don't even want to cover them. Bitcoin bear market, drag another currency. Bitcoin's bear market drags other currencies with it. I can't even read it. Could Bitcoin's bear market drag other currencies with it? The obvious answer is yes. Bitcoin erases 2025 gains. Will crypto sink deeper into correction? Why has Bitcoin erased all its 2025 gains? Bitcoin's officially in a bear market. What's next? What are these headlines? These are fear-mongering headlines. They're pulling your attention in. They're sucking you in. And the only reason I highlight that is I want to show how extreme we've gotten. Last week, I talked a little bit about Dow theory, and I talked about how in various market cycles, at the bottom, you have an accumulation period where the informed traders are starting to buy new positions. Then the public comes along, and they drive us to the next price. And then at the top, we have a distribution period where those same informed traders who kind of started to move, they end up carrying us to the next level. And they start to Excuse me, I said that backwards. Public participation carries us to the next level. The very people who started the move down the accumulation period, they start to liquidate their positions or to distribute their positions. And at those extremes, we see certain characteristics that give us a hint of where we are in the market cycle. And when we're in a accumulation period, when we're at the bottom and accumulation is starting to build up, that's when the news media is at the most bearish, the absolute most bearish. And when we're at the top and we're starting to see the distribution period, that's when the news media and all the headlines are the most bullish. Well, if you think back a little bit, in fact, let's go over to a chart and look at this. If you think back just a little bit to, I don't know, September. Can you guys remember September? Do you remember? Bum, bum, bum. How many of you remember back in September when crypto was like firing on all cylinders and it was like, we have to get in. We got to get in. Do you remember when Solana's hitting 240 and you come back over here and you look at Bitcoin back in September and October and everybody's all excited? I can't believe I just did that. I really did that. Everybody's all excited because Bitcoin was up here at 124,000. It hit over on 125 one day back in early October. Everybody's just so excited about it. And then what happens? It tumbles. Well, if you look at this objectively from a market cycle standpoint, you zoom out just a little bit, you realize that where all that media hype came in, all this media hype up here happened during a distribution period. When the very people who started to move down here in this accumulation period, this previous accumulation, and we'd seen the market driving up, they started to distribute their positions right up here at the top. And we saw the news headlines going along with that. We saw the news was extremely favorable. We saw the optimism was extremely high. Some people would say the greed was extremely high. And what did it lead to? It led to a market sell-off. Well, that's why I want to bring back up our fear and greed index. We talked about this on Friday. I'll make this as big as I can. I don't have a lot of control over how big this is. But if you can look on the right side over here, can I? Shoot, I don't know how to undo that, so I'm just going to have to reload the page. If you look over here on the right side, I'm going to see if I can zoom in from like about the last year. Okay, there we go. And if you look over here, you're going to notice we're down all the way into deep red. After Friday, I mean, Friday we were kind of starting to approach it, but we're deep, deep red. We're reading a 17, which if you come back, those are these last two readings here. And if you can see the Bitcoin chart behind it, that's the gray line. Those were the previous two market bottoms. And that's probably what we're starting to build here as well. Now, if you contrast that, you see the gray line up here at the top. This is the Bitcoin price. If you contrast that with these market highs in that distribution period that was starting, what was the greed index saying? It was extremely optimistic, very, very bullish at the time. And then we started to see that kind of waning and we got into this bearish cycle right here, okay? Now you can see if you look back at previous cycles, if you can see the gray line in here, how it was making highs back here in June of, November through June of, excuse me, that's January, not June. November through January, February of 2025. You'll notice that the greed index was very, very high and then it started to wane as the Bitcoin line itself behind it started to get higher and higher. That is an early warning that things are losing momentum and that things are becoming extreme. Well, we saw the same thing over here where Bitcoin was making higher highs and the greed index starts to get weaker and weaker until you get oversold until you get over into the fear category. And about the time that the public sentiment is extreme in the opposite direction, what does that indicate? The bottom is in. It always works like this. It's over and over and over. And I'm not guaranteeing it today. I'm not saying, hey, today is the day that this is the bottom. I'm not saying that. I am saying that my technical analysis suggests that we're very close to a bottom. I am suggesting that we're at a very solid support. I am suggesting that the sentiment indicators suggest that we are in a fear category, and we're seeing it from the headlines. Everything is fear-driven right now, and generally speaking, you want to have the exact opposite approach to it, okay? So with that said, I think that should give all of you a little bit of confidence to think, you know what, maybe we shouldn't be in the panic category. Maybe we should be looking at, what are the other possibilities of what's going on. I want to go a step further here and share a couple of optimistic stories with you. One, I want to highlight a guy named Tom Lee. He's the CEO of a pretty major exchange called Bitmine. major player in the world of crypto. And I'm not going to read the whole article for you, but what Tom goes into is he goes into how not only is he believing that we're very, very close to the bottom, but he's correlating to something we call super cycles. And he's correlating this current cycle with Ethereum into the last super cycle with Bitcoin. And his projection is still that by the end of the year, we'll be at Bitcoin 150. Will we get there by the end of the year? I'm not sure if we'll get to Bitcoin 150 by the end of the year, but he's forecasting for sure. Let me see if I can find it in here. Bitcoin 150 and Ethereum over 7,000. You probably can't read that in there, but Ethereum over 7,000. So I'm just kind of giving you some other perspectives that are out there while the news headlines are so bearish, because what happens is it becomes a bit of a self-fulfilling prophecy. You start to see the news headlines, people start to panic. Before you know it, what happens? People are selling in a panic. It just becomes a more and more self-fulfilling prophecy. In fact, it's one of the ways the news media manipulates the market. Let's take another look here. I want to show some good stuff that's happening in the world of crypto. Take a look at Kraken. Kraken is one of a handful of exchanges that are starting to offer what we call tokenized stocks. Now, what is a tokenized stock? This is actually a great bridge into part of our conversation today about the difference in coins and tokens. When you look at a token, what it's doing is it's taking an asset, in this case stocks, and it's bringing it on chain so that you can trade it in the blockchain environment. The reason this is a big story, I've been saying this for months now, years actually, but really heavily for the last 4 or 5 months. I've been talking about how we're going to start to see, and we're already seeing it, assets going both ways, both on-chain, onto the blockchain, and off-chain, onto the exchange. Last week, I highlighted for you the XRP exchange traded fund. That's a perfect example of taking an on-chain asset, XRP, and bundling it up in a way that the traditional financial world can trade it in the exchange traded fund, in the form of the exchange traded fund on a stock market. This is the exact opposite. What Kraken's doing is they're taking individual stocks, and they've got a program called X stocks, where they're pulling those stocks onto the blockchain so that you can buy and sell shares of individual companies on the blockchain through Kraken. And it's really cool. We're just really starting to see all these pieces come together of how decentralized finance and traditional finance are bridging the gap and all melding into one universe here. So I think it's really cool. I think it's an exciting story. There's a lot going on here. You can research a little bit further. But the idea of taking traditional stocks and bringing them on chain so that we can trade them as tokenized assets, this is actually what the future of decentralized finance is. And that's why it's so exciting, because we're seeing all of it coming together. All right, what I want to talk about today in our crypto basics section is I want to talk about coins versus tokens. And if you are new to crypto, you may not even know there was a difference. You may never heard the difference of the terms, but if you've been around just long enough to hear some people talk about coins and you've heard people talk about crypto tokens, you might have wondered, what is the difference? What's a crypto coin? What's a crypto token? Are they the same? Are they interchangeable? I can trade coins. I can trade tokens. I can make money with coins. I can make money with tokens. What is it? And I want to try to demystify some of that for you today in this crypto basics section. So to get started, what is the difference? We'll ask the question, what's the difference between a coin and a token? And if I were to just put it on a bumper sticker for you, here's how it works. The simple answer is a coin has its own blockchain and a token does not. That's it right there. That is the simple answer. A crypto coin has its own blockchain. A crypto token does not. That, in simplest terms, that's the biggest difference between these two. You can always think about it that way. Like if I'm trading a crypto coin, I'm actually trading a blockchain. And if I'm trading a token, then I'm trading something that's built on another blockchain. It's that simple. Now let's go a little bit deeper here and let's kind of break it down and ask the question, what is a coin? And what a coin is it's a native asset that is built on its own blockchain. A native asset built on its own blockchain. And we can use those assets to pay for things like your gas fees with Ethereum, to validate transactions, which is what Bitcoin is used for. Whenever they do the mining and they validate the transactions, they reward the miners with a little bit of Bitcoin, right? So that's one of the ways that the crypto coins are used. We can also use them to maintain security. It's one of the mechanisms that we use to kind of ensure that people aren't hacking the blockchain. Without the coins, here's what you need to understand. Without the coins, the network literally doesn't work. You cannot have the Bitcoin network and not have the Bitcoins. You cannot have the Ethereum network and not have the Ethereum coins. You must have them. They are an integral part of making it work. So some examples, I just gave you a couple, Bitcoin, Ethereum, but Bitcoin, Ethereum, Solana, XRP, XLM, these are all examples of crypto projects that are their own blockchain. Okay, so they're built on their own blockchain. They are the blockchain itself. And understanding that, another term for that is it's a level 1 blockchain. It is the core of the network. Okay, now let's look at some people. I actually want to kind of divert for just a brief moment here. Last week, maybe it was 2 weeks ago, I talked about if you can stop thinking about cryptocurrency as a currency, you'll start to understand it a lot better. The biggest misnomer of thinking about crypto is to add that word currency, because the word currency suggests money. And yes, there can be monetary value tied with crypto, but the next logical place that people go once they kind of dissociate from the idea of money is they go over to, oh, well, it's like shares in a company. This is where the SEC got messed up and why they came after XRP. And what I want you to understand is a crypto coin is not a share in a company. It's not currency, and it's not a share in a company. It's the native assets, the native coin for the blockchain. So I want to do a slide here to kind of help you understand the difference with coins and blockchains and shares in a company. When we think about a crypto coin, it is the function of the blockchain. So when you buy a crypto coin, what you're buying is you're buying the technology that makes that blockchain operate. Compare that with a stock. When you buy a stock, you're buying ownership in the company. Now, it's very nebulous because, yes, you can own a Bitcoin, or you can own a bunch of Bitcoins. And yes, you can own a stock. But when you own a Bitcoin, you do not own all of Bitcoin, and you don't really even own a share of Bitcoin, which is not even good language, but what you own is you own part of the technology. You bought into the technology. A better way to use a metaphor for this is to say, back in the day, whenever trains were coming, during the Industrial Revolution, when railways were being built across the country, if you were to buy a mile of railroad, just 1 mile of dirt that had a train track on it, and you owned that 1 mile of train track, you don't own the train. You don't even own a share of the train. You just own 1 mile of train track. But that train track is necessary for the train to travel from point A to B, and your land and your 1 mile of track is right in the middle of it. And if every time that the train has to pass your mile of train track, if you were to get a little bit of use, whatever, call it money, out of it, then you're getting a reward for owning part of the technology, the function of the train. The train can't function without the train tracks. And if you were to stick with the same metaphor, it's the same thing with crypto, specifically in the case of L1 crypto coins, level 1 crypto coins. Level 1 crypto coins are the function. So when you buy a Bitcoin, when you buy Ethereum, when you buy Litecoin, or any of these tokens, or these coins, I should say, that are the blockchain itself, you're buying the function of the blockchain. And there's value in that, just like there's value in owning some train track. There's value in owning the crypto coins. Now, if you contrast that with stock, what is stock? Stock is a share of ownership in the company. You own something. You actually have voting rights. You can actually, maybe have voting rights. You might get dividends if they pay dividends. And in a similar way, if the value of the coin goes up, you can sell it. And in a similar way, if the value of the stock goes up, you can sell it. If it goes down, you could lose value. They function in similar ways, but they are very different assets. And that's what I'm trying to articulate to you. So I wanted to use that metaphor and use that correlation to try to help you build the use case in your mind and the understanding in your mind even better of the difference between what is crypto as opposed to a currency and now as opposed to a stock. Crypto coins are part of the function of the blockchain. That's why it's not an asset it's the wrong word. It's not a security. So the lawsuit with Ripple or with XRP was the SEC was trying to say, well, XRP is a security. It was an unregistered security issue. And actually saying, no, it really wasn't. We sold part of our technology because that's what it was. That's what it is. And that's why the SEC and these regulators have had such a hard time understanding what to do with crypto because, frankly, they're stuck in the 1800s. And all they can think about is shares of stock. Makes sense? Now, let's go back to our main conversation here. What's the difference in a coin and a token? So we understand that the coin is part of the core functionality of the blockchain. A token is a derivative. It's built on another blockchain. It's not the core blockchain. It doesn't have its own blockchain. It's built on the other blockchain or on top of an existing blockchain. And what happens is what the token is it's basically a smart contract that adds functionality or it adds benefit of some sort. And so if you're not familiar with that language, what a smart contract is just think about a contract. If you have a contract between two people, one person agrees to X, another person agrees to Y, they make that agreement, that's a contract. Now, in today's off-chain world, we go through lawyers and closing agents and all sorts of stuff to facilitate contracts. But what if you could do that all automatically on a blockchain? And that's what a smart contract does. It makes an agreement between two parties and it passes it across the blockchain and it guarantees it. Pretty darn cool, right? So that's what a token is. A token is built on another blockchain. It's basically a smart contract that provides functionality on that blockchain. And like I said, it's built on another network's system. It's built on the system of the other networks. Some examples of that are things like USDC, things like Uni or Uniswap, things like Link or Chainlink is another term for that. When you see meme coins are always tokens, despite the name meme coin. You know, you look at the Pepe coin or God forbid, the Hot Tua coin. You know, all these meme coins that you've seen over the last few years, especially this year, and these, wildly volatile price fluctuations. People say, how do you do that? Well, they're not actually new blockchains. They're just tokens that are issued on an existing blockchain. In most of those cases, not all of them, but in a lot of those cases, Solana. All right, now let's move right along and let me give you another metaphor for you. Do you guys remember the "Hi, I'm a Mac, I'm a PC" commercials? Of course you do. I mean, who doesn't remember, "Hi, I'm a Mac, I'm a PC," and the Mac guy was cool and the PC guy wasn't cool. We all remember that. All of you understand what computers do, I think, at this point. For the most part, 2025, most people understand computers. When you think about a Mac, what makes a Mac unique? Well, the Mac, what makes it specifically unique is the operating system. It's a different operating system than Windows. And on the Macintosh operating system, there's certain softwares that you can run. For example, Logic Audio or Final Cut Pro or a whole slew of other softwares that can run only on the Macintosh. And on the other side over here on Windows, there's a whole bunch of softwares that only work on Windows. For example, AutoCAD, or if you're into trading, the software for TradeStation is a Windows-only software. And there's a whole bunch of softwares that only run just on Windows. And then there's some softwares, like for example, Microsoft Office or the Adobe Suite. And there's a bunch of softwares that the manufacturers of those softwares, they've decided to write and to code the softwares with different versions, but they've coded versions that work on both Mac and PC. And if they're really sneaky, they found a way to make those files talk to each other so that you can, open a file on Photoshop on a Mac, do something to it, and then take it over and open it on Windows in some way, shape, or form. Right? That's where technology is taking us. But if you can remember back in the 80s, in the 90s, when computers were first really coming onto the mainstream, you remember if you were a Mac user, the softwares didn't talk. And if you were Windows users, the softwares didn't talk. Like, you were pretty much stuck in the world of Windows or in the world of Mac. That metaphor is basically where we are in the world of blockchain. And when we think about the idea between a crypto coin and a crypto token, this is the metaphor. Think about Ethereum as the operating system. And built on top of the Ethereum blockchain or the Ethereum operating system are other projects like, in this example, USDC, the stable coin that runs on the Ethereum blockchain. Now, that metaphor holds true. Most crypto tokens are on one blockchain. So it's built on the Ethereum blockchain or it's built on the Solana blockchain. And for the most part, they don't talk to each other. Just like in the old days of Mac and PC, if you had a software that was built on a Mac, it didn't talk to the Windows software. And if you had a software that was built on Windows, it didn't talk to the Mac. And then what happened? You had developers that started to develop for both platforms. And the same is true with crypto. So you can have USDC today, you can have it on the Ethereum blockchain, or you can have USDC on the Solana blockchain, or you can have it on other blockchains as well, because they've taken the software, the token concept and the structure of USDC, and they've applied it to different blockchains. But if you ever go into Coinbase or to any of your exchanges, or if you're trying to transfer USDC from person A to person B, usually in the interface, there's going to be a question. Do you want to do this on the Ethereum blockchain? Do you want to do it on the Base network? Do you want to do it on the Solana network? What network do you want to do this on? And then it usually pops up with a little warning. Make sure your recipient is also set up to receive USDC on Ethereum. Not on Base or not on a different network. I mean, technically Base is also Ethereum, but you get the idea. Okay? And why are they doing that? Because the two don't necessarily talk to each other all the time. We have to have other technology that links the two together. And then I just mentioned the term link. That's actually the project of Link, the company or the organization known as Chainlink. They've built tokens on top of the other blockchains to start to integrate and to link up these various blockchains. So you're starting to see all these technologies coming together. That's the beautiful thing about getting into crypto in 2025 as opposed to 2013. In 2013, it was brand new. In 2025, we're starting to see all of the ecosystems coming together. And that's why you see so many companies trying to just running as hard as they can to catch up and get onboarded into the universe of blockchain. So what I want you to understand is the blockchain itself is the core infrastructure. The blockchain is the infrastructure. What Ethereum did is it provided the infrastructure or the operating system, if you will, for smart contracts. That becomes the backbone for things like decentralized finance. It becomes the backbone or the operating system for things like decentralized apps. And if you're not familiar with those terms yet, it's only because you haven't been introduced to them. But what we're building is we're building an entire financial system on the blockchain. And Ethereum is a major, major infrastructure piece for that. That's why the Ethereum token, the Ethereum coin is worth something. Because there's a lot of demand for Ethereum because it is the train tracks. It is the infrastructure for this entire world of DeFi, this entire world of DApps, decentralized applications, where you're building actual web applications all on the infrastructure of the blockchain. That's why Ethereum is so important. When you look at something like XRP, XRP is the core infrastructure of international payment structure, international payment systems. That's why XRP has a use case. And people love XRP because, in most cases, because they bought into a narrative and they were told it was going to be good, but they don't even know why it's going to be good. I'm telling you why it's going to be good. It's going to be good because it's the infrastructure for the international payments, for the entire payment structure. Okay, XLM is very similar to that. Then you look at a project like Solana. You say, well, what's special about Solana? Solana is basically like Ethereum. It's just if you were to pour rocket fuel on Ethereum, you've got Solana. Solana solved technology infrastructure issues that allow you to do smart contracts like Ethereum, so you can build DeFis and you can build DApps and other derivative projects You can build it all on the Solana network, but it's just lightning fast. It's so, so fast. And again, that's a new iteration of the same type of technology. And then you look at something like Ton, which is from Telegram. Telegram is a messaging app. They built their own blockchain and they did it, and it creates this infrastructure for messaging and for a consumer front-end interface. You look at projects like Litecoin, and it creates transaction infrastructure, kind of like Bitcoin. And so all these different blockchains, what they're doing is they're building infrastructure. Whenever we talk about we need crypto infrastructure in the United States, when the president talks about that, what he's saying is literally, we want those blockchains in America. We want that core infrastructure coming out of America. It's an America First agenda because it is core infrastructure for the global blockchain system. Does that make sense? That's why that's why so many people say, yeah, we can have lots and lots of these things. It's a narrow view to say you can only have one currency. You can only have one cryptocurrency that can win. They can't all win. That's because you're trying to say which one's going to replace the US dollar. We're not replacing US dollars. It's all about technology, and I hope you're starting to understand that. Now, if we were to go back in the day, you might remember several operating systems like DOS and Unix, and you may remember a software called Next, and you may remember a software called BOS. These came out in the 1990s, and they were the next iteration of operating systems. Well, today you don't hear about any of them. You know some of them are still in existence. You know some of them have led to different things. But unless you were there during that season of operating systems and the massive evolution of dropping these different operating systems out, you probably forgot about them or never even knew about them. Today, most people only know about Windows, Mac OS, and iOS and Android. But if you were to rewind, if you were to go back to, say, 2005, by 2005, Next had been merged into Apple. BOS had been pretty much pushed out, and some of the ideas brought into Apple and some of the things that they did with the Mac OS. DOS had been pretty much, even though it's still there, Windows, nobody talked about DOS anymore. And Unix, it's there in the backbones, running some networking stuff, but the average individual doesn't think about Unix. And if you were to ask us in 2005, when there's basically Windows and Mac OS, hi, I'm a Mac, I'm a PC, remember that? If we were to go back to that time and say, is there room for a new operating system today? Most people would say no. No, we're good, we got Mac. No, we're good, we got Windows. And yet fast forward, just 6 or 7 years later, iOS comes on the market. And it completely changes the way that we interact with the operating system. It's no longer point and click, but instead it's touch. It's touch and open. And Android has a variation of the same thing. And there's probably going to be more operating systems in the future. And what you're seeing, if you follow the technology journey, is you start to realize that technology evolves over time. Solana is a more evolved version of Ethereum. Now, Ethereum is working hard to, evolve themselves and become more competitive for that. Right now, Ethereum has huge market share, but Solana is a real threat to that, as are other blockchains that are out there. In the same way, what you're going to see as we move forward is different blockchains rise and fall, just like we saw different operating systems rise and fall. And on top of those blockchains, you'll see different tokens rising and falling. So what can tokens do? Well, let's go into this rabbit hole just a little bit. Tokens can do things like give us stable coins. What's a stable coin? Well, things like USDC, USDT, the PayPal, which is PYUSD. There's a whole bunch of stable coins. A stable coin is just a crypto token that has a value pegged to something else of value. In these cases, it's the US dollar. But you could build a stable coin for anything. There's stable coins that are built on gold. PAXG is a stable coin that is tied to gold. There's a whole bunch of things. You could tie it to a euro. You could tie it to anything you want. There's even tokens that are tied to Bitcoin. 1-to-1. Whatever Bitcoin does, this token's going to do. Okay? That's what stable coins do. And stable coins are not their own blockchain. Stable coins have to run on top of another blockchain. And the reason they're valuable for us is it gives us a way that once we convert our value, our cash US dollar asset into the world of crypto, it gives us a way to transact on these rails, on this infrastructure of crypto, of blockchain, a way to transact with the equivalent of a US dollar. That's what a stable coin is. But then you've got other things like NFTs, non-fungible tokens, where artists can create a unique digital asset and publish it to the blockchain, and nobody can copy it. Nobody can do anything other than look at it and say that's one of a kind right there on the blockchain. Absolutely locked in, unhackable, uncopyable, unique individual token. Okay. We got things like reward systems. For example, the trade coin that I built for Trade Maestro, it's a token that's built on the Solana network. And we've got a reward system that we've created a white paper for. That's going to be the back end of what we do at Trade Maestro. And so as people come into the Trade Maestro system and they watch videos and they learn more about trading, they can earn trade coins and they can trade those trade coins and they can buy and sell trade coins and they can redeem trade coins. And we create an ecosystem, an economy within a rewards network, all in this case within the Trade Maestro system, which is built on a Solana network. I didn't need to build a new blockchain for what I was trying to do with a trade coin. It wasn't necessary. Some people need a blockchain for what they're trying to do, but my project didn't need that. All I needed was an existing blockchain, and the one that worked for me was Solana. And then we were able to build a smart contract on top of that we call the trade coin. And now people can buy and sell and transfer the trade coin over that network. Okay, and tokens basically are smart contracts. That's what they are. And if we think about it in that terms, and we think about those metaphors that I gave you, the coin is the core operating system, and the token is the software that works on top of it. Now, if we were to think about what's the role of coins, role of coin looks like things like storing a value, which is what Bitcoin is primarily used for, just a place to store value. It's not really. It is functional, but it's remarkably slow. I mean, we did some transfers a couple weeks ago. It took Bitcoin like 15, 20 minutes, and it took Stellar like less than 20 seconds. I mean, Bitcoin's remarkably slow. But again, it was first to market, and there's only 21 million of them, so people treat it like it's gold. The role of coins is as a medium of exchange. Whenever people are miners and they're doing the mining operation, they get their rewards, or the gas fees, as we refer to them often. Those come in the form of the coins. And so it's a medium of exchange. Thank you for the work you did. Thank you for the energy that you spent. And I literally mean physical energy of your energy in your house or your place where your mining system is. Thank you for spending that energy and mining our processes, our transactions for us. Here's your reward. So a role of a coin can be as a medium of exchange. Can be as a medium, can be in the role of a network security. And you say, well, how does that work? Well, the more expensive Bitcoin becomes, the less enticing it is to hack it. It actually starts to secure itself simply because it takes too much to hack it. It takes too much money to hack it. It takes too much effort to hack it. The bigger the network becomes, the more expensive the token becomes, the more valuable the network becomes, the more secure it becomes by second nature. And so these are just some of the roles of the coins. When we think about the role of the token, on the other hand, the token brings along things like governance. So you can vote on protocols. It brings along utility, such as giving access to platforms, reward systems. It's a layer that's on top of the core blockchain. It's a way to tokenize real assets. I talked about that in the news segment where I talked about stock assets being tokenized and brought on chain by Kraken. They do that through layer 2 tokens. That's the way that you do it. And what you're seeing is you're starting to see the entire ecosystem coming together. After 15 years now, it's all coming to fruition. And this is the future of finance. It's the future of a lot of things, even beyond finance itself. We're looking at medical care. We're looking at insurance documents, insurance itself, all kinds of contracts that we deal with in the physical world day in and day out can be brought on chain and put on the blockchain and worked within this ecosystem. So if we were to conclude all this, here's how I'm going to wrap it up. What you see today is just the beginning. What you see today in the world of crypto is just the beginning. More blockchains are going to arrive. Don't fall for the idea that, we don't have room for any more blockchains. There's going to be more. There's going to be a lot more. And just like there was a lot of operating systems, there's going to be more blockchains. More tokens will arrive. And when you see them arrive, don't fall for the narrative, we can't have more tokens. Yes, we can. We absolutely can, because there's a whole bunch of different softwares that are out there, right? They do different things. There's Adobe and there's Microsoft and there's, Intuit and all these different software companies that build different softwares for different things. The same thing is true with your crypto tokens. There's going to be tokens for everything. We've already got tokens for everything, but there's going to be even more. There's going to be a lot that show up. There's going to be a lot that disappear. And the key thing that I want you to know is there's going to be room for infinite of them. And what your job is going to be is to look at the projects, look at the ideas, look at what they're trying to do and say, is this something I want to get into? Understand, am I buying a level 1 token, a level 1 coin, which is part of a new blockchain? What am I buying into? I'm buying into XRP, the blockchain. I'm buying into Bitcoin, the blockchain. Or am I buying into a token that's built on top of it? If I'm buying TradeCoin, what am I doing? I'm buying into a reward system that is part of the Trade Maestro ecosystem. That now you know what you're buying into. And so hopefully this gives you a good explanation and it gives you a good breakdown. Hopefully you have a much better understanding of it. And if you have any questions, feel free to type it into the chat. I'll do my best to answer them. And now you have an idea of the difference between coins and tokens. All right, that segment lasted a little bit longer than I meant for it to last, but that's all right. Hopefully you got a lot out of it. And as we wrap up today, I'll try to get this done in 15 minutes. I want to teach you how to read candlestick charts. You've been seeing me using my charts, and whenever you look at something like, well, not that one there, but when you look at something like this right here, and you see these little red and green things on the chart, and I refer to them as candles, you might be wondering, what in the world are these little red and green things? And again, I've called them candles, but you may have no idea what they are. They don't look like candles unless you know what you're looking at. So I want to give you a quick little introduction into candlestick charts and how we read them. As a very quick point of candlestick history, candlesticks actually come to us from Japan, from the Japanese rice traders. This is an old technology. When I say it's an old technology, I mean it's really old. Candlesticks as a charting tool started to evolve in the 1700s. Actually, we've got history going back in the late 1600s with a guy named Sokyo Honma, who was one of the original, one of the first famous traders from Japan, kind of like Jesse Livermore of Japanese fame. And he was not just using candlesticks, but wrote how-to manuscripts on how to use candlesticks and how to trade with them back in the late 1600s. So they've been around for a long, long time. Very popular in Japanese trading history, but they kind of got lost, especially during around the time of the Second World War, until the late 1980s and the early 1990s. And a man in the United States by the name of Steve Nissen brought them to America, published a book on it in, I think, 1991, maybe 1992. And that's where candlesticks became introduced in the United States. And since then, they've just not only grown in popularity, but the ability of how we use them and how we apply their insight into our trades has just become commonplace. It's what we're used to doing now. So it's one of the oldest technical analysis tools that are out there. And ironically, in United States history, as far as trading is concerned, it's a relatively new tool, but it's been around for a long, long time. They've been around for a long time. So with that said, well, look at that. We got the exact same slide twice. I wonder how that snuck in there. Maybe I pushed the button the wrong way. I don't know. Let's talk about some basics of candlesticks. The basics. A candlestick is simply a different way to look at the 4 key price points of the market, which is the open, the high, the low, and the closing price of the day. The open, the high, the low, and the closing price of the day. So whenever the market opens, there's a price point that's marked as the open. There's a high of the day, there's a low of the day, and there's a closing price. And we can represent any time frame. It can represent a 5-minute candle. It can represent a day, a week, any intraday time frame. When you see a candlestick chart, it just simply represents, each candle represents that time frame for that chart. Now, they're different than bars, if you're familiar with chart bars, because the bars have no color associated with them. But with the candlesticks, there's a color associated with them, and the colors become very distinguishing for us. It makes it really easy for us to read them. So there's 2 types of candles. There's what we would refer to as an open candle or a white candle, and a black candle or a closed candle or full candle. There's a lot of ways you could refer to it. And basically what a white candle is it has a higher closing price than an opening price. And when we look at a black candle, it has a lower closing price than it is an opening price. That's all the distinction is. So with a white candle, you start at the bottom of the candle body and you draw it up to the closing price. With a black candle, you start at the top of the candle body and you fill it in down to the closing price. And the little candle shadow, the little tiny part on the top and the bottom, that's going to mark the intraday high and the intraday low. Now let me talk briefly about color. We refer to them as black and white. And the reason we refer to them as black and white is because if you're on a white piece of paper and you draw a candle from the opening price up to the closing price and you don't color it in, it looks like it's white because it's on a white piece of paper. But if the back of that paper was black, then it would look like a black candle. Or if the back of the paper was green, it would look like a green candle. Or if the back of that candle, whatever the paper was drawn on, if it was fuchsia, it would look like a fuchsia candle because it is not colored in. Now, when we look at a black candle, what it really should be called is a solid candle. Because the way that you construct a black candle is you start at the opening price of the day and you color it in. You literally fill it in with all the way down to the closing price of the day. And so you end up with what appears, if you're using black ink, to be a black and white candle. Black ink on white paper looks like black and white candles. If you use blue ink on white paper, it looks like blue and white candles. If you use red ink, it looks like red and white candles, and you get the idea. Now, the reason I mention this is because today, in 2025, with modern computers and beautiful charting softwares that we've got, people have completely lost the understanding of hollow candles and solid candles. They don't understand that the color actually does matter. You'll usually see me using, well, now I've kind of morphed, but for years, for literally years, all I would use was black and white candles on white background because that's how I was trained. That's how I learned to interpret candlesticks. And when you look at a basic candle chart, like the one you see on the screen, I'll make it full screen so you can see a little bit better. You'll notice it's a white chart and you've got white hollow candles and solid black candles. Now, what I have done is I have created a hollow candle that you'll see on my charts, and they look a little green because they're outlined in green. But if you can see them, you'll notice, I don't know how well you can see it on the chart here, but you'll notice that the green candles are actually black because the background of my chart is dark. And you'll see the red candles are actually solid because I had them colored in that way. Now, I make a big deal about this because most people, they don't know the history and they weren't trained with hollow and solid candles. And what they do is they'll just go flip their, what they would call bullish candles green and their bearish candles red. But that's actually not right because then you end up with all solid candles and it messes up somebody like me who learned how to interpret hollow and solid candles because that's what I learned to interpret. And so when you look at my charts and you see that I've got these green candles that are, have a black background, you're like, why is he doing that? It's because they're hollow. And that's the way that I know how to interpret the data. If you literally color my candles solid green and solid red, I will be confused. I will misinterpret the candle signal, not every time, but more often than not, because my brain literally cannot make the shift. And it might seem stupid to you, but for those of us who were conditioned in that world, it's not. Like, it's a very real deficiency at this point. So anyway, that's just a little bit I want to talk about with colors. We've already talked a little bit about the construction, but I'm going to show you the breakdown of how we construct them. Like I say, you've got 4 key price points of the day: the opening price, the high price of the day, the closing price, and the low. Okay, so the open, high, low, and close. And when we put those on a candle, it's going to look like this right here. You've got what we call the candle body and the candle shadow. 2 parts of the candle. The body is either the white or the black part of the candle, or the hollow or the solid part. That is your candle body. The little stick on the top and the bottom, some people call it a candle wick, but it's really a shadow. That's the term that we use. It's the candle body and the candle shadow. Now, like I say, there's 4 price points: the open, the high, the low, and close. Look at the white candle on the left, and you'll notice the bottom of the real body is the opening price of the day. The top of the upper shadow and the bottom, the lower shadow, that's the high and the low price of the day. And you'll notice the top of the white body, or the hollow body, is the closing price of the day. So there's your open, high, low, and close. Now, if we're looking at a dark candle or a solid candle, you'll notice that we draw it the same way. The opening price, however, and the closing price are basically flipped. The intraday high and low are the same, but we have a higher open than we do close. And since it's a lower close than we have open, we draw the price down and we color that candle body in. That's the only difference. So when you look at a candlestick and you see a white candle or a hollow candle, or you see a black candle or a solid candle, your brain can immediately say that's a higher open than close, or that's a higher close than open. That's a lower close than open in the case of a solid candle. And you can immediately make the connection that you need to make in terms of what's happening with the price action. Now, let's take an example here of this chart right here, and you'll notice that sometimes you got two green candles back to back, but one of them's lower than the other. And if you don't know what you're looking at, that might just mess you up, because we've been conditioned, especially in the Western world, we look at the end-of-day ticker tape. Whenever I pull up something like this right here and you see, oh, Bitcoin's down to 2,500 points, which is 2.67%. And if you were to look at the candle on that, it's probably red. We'd have to go look at it and see. But when you look at that, you immediately think to yourself, oh, red is bad. Red is down. But let's come over and let's take a look at our actual candle, and it is red. You'll notice that it actually is red. But a lot of times, not all the time, but a lot of times, you'll have a situation like this right here, where the candle might be green, but if you look at the ticker tape, it's going to read red, because this closing price, if you can see my mouse moving here, this closing price is lower than the previous day's closing price, and that's why the ticker tape prints it as red. But the candlestick is telling a different story. What the candlestick is showing is it's showing that we had a higher close today than we had an opening, and that's actually an indication. That is the indication. That's what you need to see. You've heard me talk about candlestick shadows. You've heard me talk about the buying at support and selling at resistance and all that stuff, and that doesn't show up in the end-of-day ticker. When you look at something like this right here and you just see that we're up or we're down, it doesn't tell you the narrative of how we got there. It doesn't tell you the story of how we got there, but the candlesticks do. The candlesticks tell you. And so the reason that this second candle on this chart here, the one I've got the arrows drawn to, the reason that it's green is because the candle has a higher close than it had an opening price. And yet, even though the price itself is lower than the previous day. But what it's telling you is it's telling you that buying pressure is coming in and it's starting to create support, even though you're in the middle of the swing here. Okay, so let me give you some general principles and then we'll wrap it up for today. Some general principles as it relates to candlesticks. Number one, a single candle is a candle line. A single candle is a candle line. Number two, single candles in and of themselves have meaning. We'll talk about these more in the future as I share some more insights into candles, but single candles on their own do have meaning and do give us insight. Number three, when you have more than one candle together, multiple candles, they have more meaning and they give us additional insight. And then the most important factor to understand is location. You'll hear me say about candlesticks, location is the most important aspect. Just like in real estate, location, location, location. The exact same candlestick formation in a different price location can have two totally different meanings. So location is the most important factor. And last but not least, candles give us a story or an indication of sentiment and trading psychology. When you look at a candlestick, when you look at this chart, it doesn't tell you anything about the sentiment. All it tells you is that everything's red today. When I look at this chart and I see these candlesticks and I see this big red candle, that tells me about sentiment. That tells me, if I look at this right here real fast, I'll kind of interpret it for you. This red candle tells me I opened at this price. I traded as high as this point, but the bears were too strong. They came in and overpowered the bulls. They drove the price down, and currently, not only is that the closing price, if we were to close right here, that is the low price of the day. And so if this was the opening price, you had your intraday high, and the bears have been in charge, and we close it, we fill it in. That's how you construct that candlestick. And it tells us the bears are solidly in control today, driving the price down, the selling pressure, driving it down. Let me show you a couple of other examples just so I don't leave you on open loops here. See if I can find a couple others that are happening. Take a look over here. I may not have any in crypto today. Everything's kind of selling right now. But if you look at something like If you look at something like this candlestick right here, you see how that long lower candlestick shadow is hanging out there? That's actually telling us that the buyers are coming in. And notice where it happened. It happened on this support level right here. And so when you see, yeah, it was a red candle. Yeah, it was a lower close than the previous day and a lower close than the open. But the buyers, while they sold off all the way down here intraday, they started to come back in and started to push the price back up. And those start to become indicators, early indicators of where the buying pressure is showing up and where the future's going. So hopefully this gives you a good little introduction into candlesticks. I'm sure you're going to have a lot more questions about it. It's a great study. I have a full training on it. It's about 3.5 hours. So, short of going that deep, this is just kind of a little bit of a baby step, a little bit of, tiptoe into the world of candlesticks. So you kind of get an idea of what's going on. If you have any questions, obviously type it in the chat, type it in the comments, or send me an email, jeremy@trademaestro.com. And if you need to find me, you can find me over at trademaestro.com. I want to thank you. I want to thank you for being here today. And if you got any questions, again, send it in. If you have not already done so already, please like and subscribe, follow us, help us out, spread the word, share what we're doing, and give us some feedback. Let me know what you think. Let me know what's going on in your world. On Rumble, we're Trade Maestro. On YouTube, it's at Trade Maestro. Real Trade Maestro on Telegram, and Trade Maestro Official over on Facebook. Thanks again for being here. Hope you guys have a wonderful rest of your day. And until next time, happy trading. We'll talk to you soon.